Good morning, my name is Yasha and I help young men invest in the stock market. So today we are going to analyze State Street Corporation with the stock ticker STT because they have $4 trillion in assets under management. So quite an interesting company, and let's take a look at it together, okay? As always, we are going to analyze State Street using this little Canva presentation that you see right now on the screen. So let's begin. First of all, why should you even listen to me? As you know, my name is Yasha and I help young men invest in the stock market. And when you have more trust for me, the first link in the description will take you to my one-to-one coaching. So see you on the other side. Now let's begin with the actual analysis. So this is going to be very beginner friendly, simple, straightforward. If you are a beginner, you will learn a lot about stock market analysis. So grab a piece of paper, grab a pen, and let's go, okay? Now generally, as a complete beginner, you should care about the following 6 things whenever you analyze stocks, okay? You should care about chart, profit, debt, money on the bank account, value, and price. Now here you have some quick facts about State Street. It's a company that works in capital markets and it was founded in 1792. Like, what the fuck, man? That's like 300 years or something. And they offer a whole lot of shit. And what I mean by that is from loans to financing, to asset management, to risk management and all that shit. Like literally everything that you think about, okay? Now here is immediately the first thing that you should pay attention to whenever you analyze stocks, okay? So let's take a look when the company was founded in 1792. As a rule of thumb, whenever you analyze stocks, you should think about that the older the company is, the better and safer investment it is, because the older the company is, the more crises they survived. And if they are still here today, that means that they survived those crises with quite a good management. You know what I mean? So for example, this company is almost like 240 years old. So they survived a lot of shit. They survived, I don't know, American Revolution. They survived, I don't know, world wars. They survived a ton of stock market crashes. And they are still here. You know what I mean? Whereas if you have some startup that was founded maybe 1 year ago, for them it's much more riskier because they have never experienced the crisis. But this company has been literally through everything. So whenever you analyze stocks, just keep in mind the older the company, the better. The higher the chances are that they will also survive in the future. That's easy, okay? And now we come to the chart. And for chart we have an instruction that chart has to grow for all 10 years. Now what exactly does that mean? That means that I will draw a little exponential line, kinda like that. And we are going to compare the actual stock price chart, which is the orange line, with this black line. And preferably they should follow each other because whenever we invest in stocks, we want to invest in growing companies that are expanding the business, that are more and more profitable, because those are just companies that will make us money on the long term, and we want money, okay? Now, what do we have here? Here you can see that we have a typical banking chart. Now, what exactly does that mean? That means, bro, that the chart goes down, up, down, and then slowly up. Every banking chart is like that. Like, this is typical for banks. The charts go up and down constantly. That's why I don't like to invest in banks, because the chart is inconsistent. And the same thing is here as well. You can see that it goes constantly up and down, up and down, up and down. We don't have that nice growth, let me draw you. So if this is a chart, we don't have like that growth towards the top, but we have something constantly up and down without the momentum like towards the top, you know what I mean? So I'm repeating myself way too much, but I really want that you understand that, okay? So if the chart doesn't grow to the right, then that's a bad thing, okay? And here it goes up and down, but not towards the top, so that's a bad thing. Now we come to the profit, and for profit we also have an instruction that it has to be in plus and it has to grow as well. Now here is the very same story. I will draw a little exponential line, kinda like that, and we are going to compare whether the profit grows or not, and in this case, yes, it does, except last year, because you can see that the trend actually went quite well upwards, so they are good to go here. Obviously last year something happened, I don't know, I need to take a look in the report. Let me know in the comments if you want that, but generally the profit increases, which is a good thing. Okay, now we come to the debt, and instruction tells us that it has to be low and preferably it should also decrease through the years. Okay, now what do we have here? Here we have exactly the opposite. The debt is actually growing, but keep in mind that this is a good thing, because think about it, this is a financial institution like a bank. Okay, and how do they make money? With loans and with investments. And how do you increase investments with the same amount of money that you have? With a loan. Okay, so they took a loan, they took money from others and invested in, then made the money and repaid the loan and kept the profit. It's that simple. That's how banks function. Okay, so the same thing is right now here with this. The more the more debt they have, the more loans they took, and the more investments they made. Okay, so in that case it is a good thing that they have a growing debt, because that means they are expanding the business, because their business depends on the loans. Generally, if it would be a normal company, yeah, it would be bad, but in this case not. Okay, now let's come to the money, and we literally measure the money that they have on their bank account. Just like you are a young man, you have probably $400-500. Here we measure the same thing. How much money do they have on their bank account? It's that simple. And preferably they should have more money than they have the costs, because that's just better in case of something unexpected. You know, they can cover quickly, they can react quickly, you know, they can handle the situation easier. Whereas if they have zero money, it's much harder to do that. Okay, now what do we have here? They have minus $126 million. So whenever you have a negative bank account balance, that's a bad thing. Okay, bank account balance means how much money you have on the bank account. Okay, now they have a negative one, so that's a bad thing, because that means that they do not have more money than the costs at this exact moment, because otherwise they would have the bank account balance in plus, but they don't have it. So if something unexpected happens, they have to take another loan to repay that unexpected event, plus all of the loans that they have already, you know. So that's a bit unsustainable. I don't like that. So the money is not a good thing. Now we come to the evaluation, and obviously as a good investors, we want to invest in stocks that are undervalued. Okay, how do we measure valuation? By two things. First thing is called P/E ratio, and the second thing is called intrinsic value. Now, as a complete beginner, those concepts might sound a bit weird and strange, so let's explain them. Okay, P/E ratio is used to calculate, or at least to compare, the State Street Corporation with its competitors and the whole stock market. Okay, this is how we find undervalued stocks. Okay, and P/E ratio should always be lower than 15, because the average P/E ratio of stock market as a whole entity is 15, and obviously we want to invest in stocks that are below that, because those stocks have higher chances to grow in the future. Okay, now how is P/E ratio of State Street? You can see it here, just around 15, slightly a bit more. So in this case I think we can do an exception and still accept the State Street as a fairly valued stock in terms of the P/E ratio. Okay, and now we come to the intrinsic value, and this will sound a bit strange, but it's actually a very simple concept, so I want to have your full attention. Okay, intrinsic value tells you the price that the company should have at this exact moment. but the current price is then the current price. Okay, so let's take a look at the example here. Intrinsic value, based on intrinsic value, State Street stock price should be $126, but the current price is $84, literally exactly 84. So that means that the current stock price is actually for around $20 less than it should have been. You know what I mean? So intrinsic value tells you the price that State Street should have, but the current price tells you like the literal price. Okay, it's that simple. And in order for stock to be undervalued, intrinsic value should be higher than the current stock price, which is exactly the case here, because the price is for $40 approximately lower than the intrinsic value. So that's a good thing, and stock is overall undervalued. At least in terms of the P2E, it's fairly priced, okay? Now you can find P2E and intrinsic value in Google. Just write State Street Corporation P2E and State Street intrinsic value and you find the data. It's that simple. And now we come to the price, and for price we have an instruction that it has to be lower than 150 euros, or since you are from America, for you $150, okay? Now the current price of State Street is exactly $84, which is by around 2 times less than it should have been. So that's a good thing as well. The stock is not overpriced, because whenever you invest in stocks, keep in mind that $150 should be the absolute limit when you buy the stock, no matter how good it is. Because when you are a young man, you have a tight budget, you have maybe 400, 500 euros that your grandma gave you, you know, so you want to invest that money. But if you buy one stock that costs $400 or $500, like what will you do with that, literally? Because then you have just one stock, and if it drops, then you have a loss. But if you buy, I don't know, if you buy 5 stocks each with the price of around $100, just like we have right now here, sorry, I don't know what happened. If you have like 5 stocks with around $100 each, then if only one drops and others increase, you are still overall in plus, you know what I mean? So that's a better strategy. So yeah, below 150 is the rule of thumb. This one it is, so we are good to go. And now we come to the final evaluation, where we are just going to summarize everything that we found out about the company, okay? Now, does the chart grow exponentially? No, it doesn't. It goes up and down, just like a typical banking chart. Do they have profit? Yes, they do, except in the last year when they had a bit less profit, but overall the profit grows, which is a good thing, okay? Now, does the debt decrease? No, but that's a good thing, as I told you, because this is an investment company and they are giving loans and they are investing, and for that you need to have more debt, because more debt is equal to more investments, which is equal to more money coming in, okay? Do they have money on the bank account? No, they have, I think, minus $120 million on the bank account balance, so that's a bad thing for us. Is the stock undervalued? Yes, it is. And is the price below $150? Yes, it is. So, should you buy or sell? In my opinion, honestly, I think that this is a nice buying stock, because it's first of all an old company. Like, this is the oldest company that we've analyzed so far. So yeah, this gives us additional security, okay? Then this is like a bank, kinda. This is like some financial institution, whatever. They are doing whole lot of shit, whole lot of like investments, whole lot of services. So they are good to go. The only thing that I don't like is the chart, and that they have increasing debt, but that's actually a good thing. As I told you, they are reinvesting the money back. If you want to know more about, look here, I have detailed analysis. They are reinvesting the money, which is shown on this graph. Then they are quite profitable. Then I don't know, like increasing dividends, which is a good thing, and overall just good company. I don't know what to say, but look, the margins are nice, the total revenue is growing, like the company is growing, it's a nice company. It's that simple, bro. I just have that feeling inside myself, like, yeah, okay, if I would have some additional money at the moment, maybe I would buy it, you know? It's a good company, it's a nice price, it's fairly valued. I like it, actually. I actually very like it. And all other data that we analyzed seems that it's a good one. So yeah, if you want, put it on a watch list. That's the minimum that you can do. Maybe even buy it with small amounts, you know, and then let's see what happens, you know. Now, if you want to know more about stock market investing, I invite you to click the first link in description. I will teach you everything about it. I also invite you to click subscribe and join me on this journey to become a millionaire with stock market investing. Do the hard work, my friend, and see you on top of the world.